So what does it mean for home affordability with these higher interest rates? With mortgage rates rising, hitting their highest levels in decades, potential buyers and sellers alike are asking, why are rates continuing to rise and what does it mean for the future of home affordability? Let's break down the driving forces behind these changes and explore strategies for navigating today's challenging housing market. To understand why mortgage rates are climbing and how it affects home affordability, let's break down a few key points. Number one, mortgage rates and the Federal Reserve's influence on them. The current 30-year fixed mortgage is around 7%, primarily influenced by the Federal Reserve's policies. Since 2022, the Fed has been committed to fighting inflation by increasing the federal funds rate, impacting all interest rates in the economy, including mortgage rates. When the Fed signals potential rate hikes or maintains a high rate, investors demand higher yields on a Treasury bond to offset the inflationary risk, causing a ripple effect on mortgage rates. Number two, the role of the 10-year Treasury yield on mortgage rates and how it affects the market. Treasury yields have a close relationship with the mortgage rates, and lenders often use the 10-year Treasury yield as a benchmark for pricing long-term loans. When Treasury yields increase, lenders raise the mortgage rates to align with these higher yields. Treasury yields have fluctuated in response to inflation concerns and global economic conditions, with recent increases driven by a combination of inflation fears, U.S. federal fiscal policy, and global market volatility really affect this. Number three, impact on home affordability with these higher mortgage rates and its significance on the impact of home affordability. As rates climb, monthly payments on new mortgages increase, reducing the purchasing power of potential buyers. For example, on a $400,000 loan at 4%, you have a monthly payment of $1,910. But at 7%, your payment jumps up around $2,660, which is a difference of around $750 a month. And this is going to put a lot of strain on the buyers, especially those on the edge of qualifying for their loan. Or in the high income areas like Scottsdale and Paradise Valley, you're going to have decreased purchasing power. The bottom line is, with higher rates, buyers can afford less house for the same monthly payment. A borrower who could qualify for a $500,000 mortgage at 4% can only qualify for $350,000 at 7%, limiting the options in a market already constrained by limited inventory. This restriction reduces buyer demand and can force some buyers to consider home purchases or delay them until rates stabilize. Pricing also pressures the sellers. When buyers' affordability diminishes, sellers often feel pressured to lower their prices or offer incentives such as covering closing costs or buying down points on a mortgage to reduce the buyer's rate. In markets where the sellers were previously able to secure premium prices, this may shift, requiring adjusting your expectations of what you can buy. Sellers who resist adjusting their prices may experience longer listing periods, especially if the home requires updates or renovation. In a slower market, fewer qualified buyers maintaining realistic pricing is essential. Number four, psychological effects on buyer and seller behavior. The psychological impact of rising rates can influence buyer confidence. Many potential buyers will adopt a wait-and-see approach to rising rates, waiting for rates to drop, while others are going to be forced to rushing into a purchase to avoid further hikes. This reaction can create imbalances in the market where the buyers are taking on financially unstable payments to secure a home, now potentially leading to an increased financial strain in the overall economy. For sellers, the perception of a declining buyer pool may lead to a quicker price reduction or acceptance of a lower offer than they would have accepted in a low-rate environment. This psychological impact can cause volatility in home prices, with some neighborhoods experiencing more dramatic price adjustments. Number five, the future outlook. Short and long-term rate forecasts. The Federal Reserve has indicated that higher rates may persist through 2024 as inflationary pressures remain a concern. This forecast suggests that mortgage rates are unlikely to fall dramatically in the next few months. Small fluctuations may occur in the economic data, and we may see changes. As for the long-term forecast, the Federal Reserve could begin easing rates if inflation returns to target level, likely affecting the Treasury yields and leading to a gradual mortgage rate reduction. However, the timeline for this adjustment remains uncertain. Most experts advise that buyers prepare for ongoing high rates and adjust their housing expectations accordingly. Number 6. Strategies for prospective buyers and sellers. Given these dynamics, prospective buyers and sellers consider the following strategies, or should consider them. For buyers, consider an adjustable rate mortgage. Although ARMs carry higher risks, they offer lower initial rates, which can provide more manageable payments for those expecting relief within a few years. Look into mortgage rate buydowns with the sellers. Many lenders offer buydowns where the buyer or seller pays up front to reduce the interest rate, or ask for the seller to do that. That'll help ease the initial payments and affect affordability. A higher down payment definitely reduces the amount financed, thus lowering the monthly payments, potentially qualifying buyers with better rates. For sellers, they can offer concessions. Sellers may offer to buy down a mortgage rate, cover closing costs, make minor home improvements to increase the market appeal. A market strategy. Homes that are move-in ready, maintained and priced competitively, stand out in these slower markets and tend to attract more serious buyers. Be open to negotiation. Sellers need to be more open to flexible with their terms in these high interest rate environments. Number 7. Long-term effects on real estate. In the long term, sustained high rates can impact real estate market, potentially slowing down home appreciation. Home prices typically stabilize or appreciate more slowly when the rates are high because fewer buyers can qualify for these loans. This trend could benefit some first-time home buyers who might enter the market at these lower price points, while current homeowners may be less inclined to sell, losing the risk of the existing low mortgage rate if they purchase a home or a new property at these higher rates. Another possible effect is an increase in rental demand. Buyers who feel priced out by the market due to these high mortgage rates often turn to rentals, driving up the demand for rentals and in the long term, the rental prices. This shift may offer investment opportunities in rental properties as rental income may rise alongside demand. Concluding thoughts: adjusting to the new rate environment, the current high rate environment, requires both buyers and sellers to adjust their expectations and strategies. While affordability is impacted, market adjustments can still create opportunities for those willing to navigate changing conditions. For those considering entering the market, it's essential to stay informed, evaluate financial options, and work closely with a mortgage professional who understands these market fluctuations. With thoughtful planning, adapting, both buyers and sellers can find ways to achieve their goals even in a challenging rate environment. Ultimately, whether rates climb or fall, the real estate market will continue to evolve, creating both challenges and opportunities for those prepared to adjust their approach. Thanks for watching today. Keep an eye on the 30-year fixed mortgage. It'll tell you what's happening with Treasury yields, or you can watch the Treasury yields and that'll tell you what's most likely happening with mortgage rates. Don't forget to take a look at some of our other videos. Thanks for watching. Have a great day.